Welcome guys to today's episode. Okay, this is the first series of the smart money advanced trading model. Okay, so now if this is your first time of coming across this channel, please do well to subscribe, turn on the notification bells to get notified once we upload our weekly video. Okay, so now before we get down, I actually want to say that the smart money advanced trading model is actually a bit different from the 2022 model. Okay, so what is going to happen is that it's up to you, okay, to decipher the one that is going to be easy for you to understand. Okay, so because the concepts are more like they are a lot much compared to the 2022 model that's focused on just fair value gaps and liquidities. Okay, so with that being said, let's get down to today's teachings. Okay, so now the elements to a trade setup, the advanced model. Okay, so now the context surrounding a trade setups are: the first thing we have here is the expansion, the retracement, the reversal, and the consolidations. Okay, now the reference points in institutional order flows are order blocks, fair value gaps and liquidity voids, liquidity pools and stop runs, then finally equilibrium. Okay, so these are the reference points that institutional mindset traders make reference to, okay, when looking at price action. Okay, so now the context always surrounding institutional trader mindset setups are always built around these four things. Okay, they are built around expansion, retracement, reversal, and consolidation. Okay, and now most of us are already familiar with this. Okay, I actually talked about them in the 2022 mentorship series. Okay, so I talked about this, and we are actually going to look at the advanced aspect of it. Okay, we're going to look at the advanced aspect of it. So I'm going to try the best of my ability to make this thing easy, and trust me, I'm still learning the concepts and I'm not really good at it, but I'm just going to try the best of my ability to make it easy for all of us to understand. And okay, it doesn't matter, it doesn't mean it's not really important for you to learn this concept as well the 2022 model. Okay, you can just stick with the 2020 model. They are all working, they are all smart money concepts. Okay, they are all working very well. Okay, so now this was what I was actually working with before 2022 model. Okay, and if I'm going to be honest with you guys, I actually fell in love with the 2022 model, and I haven't really you won't see me talk much about this advanced model. Okay, you won't actually see me. Although I've made some reference to it. Okay, I've made some reference to it in the previous videos, but I haven't really talked much on this advanced model. Okay, so now let's get down. Now the algorithmic delivering of price. Okay, we all know before now that price is being delivered by AI, artificial intelligence, right? So before now it used to be a kind of a manual process, right? So but with the age and emergence of sophisticated uh, computers, coding, and the rest, the world is actually advancing technology. Okay, so now the algorithmic delivering of price is actually based on this. Okay, so now this is how price is being delivered on a daily basis to the marketplace. Okay, so there is nothing outside of this is how price is being delivered, and this is what I'm actually going to share with us today. Okay, so now most of us may have heard about this concept following ICT up. Okay, and most of us may not have heard about it. Okay, so now we're going to talk about how price is being delivered to the marketplace on a daily basis. Okay, so now this right here is the algorithm that deliver price. Okay, which is known as the interbank price delivery algorithm. Okay, so this is how it's coded, this is how the AI works. Okay, so now in every day-to-day trading, okay, now I want you guys, like I said, will say, I don't want you to believe what I'm saying. I don't want you to take my word for it. I want you to actually go into your your chart and do a back test on this. Okay, now on every day-to-day trading, on every day-to-day transaction, on any daily transaction, the price always starts from consolidation. Okay, on every daily transaction, on every daily basis, the market, the price uh, always starts, the day always starts from some level of consolidation. Okay, now there are times when this is being applied to sections. Okay, but that is more advanced side of it. Okay, and that is a kind of a topic aside the scope of this teaching. Okay, so now on a day-to-day basis of on price delivering algorithm, okay, the day has to start with consolidation. Okay, so now guys, this is the importance of consolidation. Without a consolidating market, there is never going to be price delivery. Okay, there's never going to be an efficient delivery of price. There's never going to be smart money. There's never going to be blueprints to follow up. Okay, there's not going to be blueprints to look out for. Okay, so if we don't have a consolidating market, smart money traders would have blueprints to follow, would have footprints rather to follow in the marketplace. Okay, so now price is being delivered on a day-to-day basis with the start of a consolidation. Okay, so now once price consolidates, the next phase it moves to is expansion or reversal. Okay, so now the opening of a day never starts from expansions, neither did it will it start from retracement or reversals. The opening of every day 12 a.m. Midnight New York is always starts with a consolidation. Okay, there's going to be a sort of a consolidation. Maybe it might not be visible on the 15-minute time frame, but it might likely be visible on the 1 minute time frame or the 5 minutes or thereabout. Okay, so there's going to be always a form of consolidation, right? Remember, price is fractal. Okay, price is fractal in nation. What that means that whatever happens on the higher time frame is probably going to happen on the lower time frame. Okay, so there are going to be times when these consolidations might not really be visible on the 15-minute time frame. Okay, but trust me guys, it's there. Okay, because without this consolidation, there is never going to be efficient delivery of price. Okay, so now the next phase after consolidation is expansion or reversal. Okay, now price does not move from consolidation to retracement. Okay, please take note of this. Price never moves from consolidation to retracement. Okay, price moves from the consolidation phase, which is this is the 12 a.m. midnight. This is price right now, and price just opened up the 12 a.m. midnight or on each session, and I've actually pointed that out to us on our previous videos, right? I've actually pointed out some consolidations prior to this video. I pointed out some consolidations on each before or after each session's opening time of day. Okay, so now this is why it does that. Okay, because without consolidations already, it's never going to be an efficient delivery of price. Okay, so now once we have consolidation, the next phase we should be expecting is the expansion or reverse. Okay, so price will never go from a consolidation phase to a retracement phase. Okay, it has to move from consolidation to an expansion or from a consolidation to a reversal. Okay, so let's say price moves from a level of consolidation to expansion. Okay, the next stage price is going to go to is either retracement or reversal. Okay, it's going to go from retracement to reversal. Okay, so once there's a consolidation, there's going to be an expansion. Then from expansion, we're going to have a retracement or reversal. Okay, so this is how price is being delivered around on a daily basis. Okay, it starts from consolidation, then expansion, then likely move to a retracement or a reversal. Okay, so once we have consolidation, the next phase we anticipate is expansion. Okay, once we have expansion, it moves to retracement or reversal. Okay, so that is how accurate this can be, and that is how price is being delivered and on a daily basis, on a day-to-day basis. Okay, so I'm going to show you how that actually look like on the price chart. Okay, so we should have this in mind. The algorithmic delivering of price on a day-to-day basis is built on the concept of deliverance of price on a day-to-day basis is built on the concept of consolidation, expansion, then retracement or reversal. Okay, so mind you, price will always start with some level of consolidation, then moves to the next phase, which is expansion. Okay, and then the next phase we should anticipate was the retracement or reversal. Okay, so there is no other two ways about this, and this is how price is being delivered on a day-to-day basis in the marketplace. Okay, so I'm going to show that to us now, right now. Okay, so now this is the daily range. Okay, so this is the daily range, this is actually the daily range. Okay, so we can see I have the New Zealand USD 50-minute time. Okay, now the interbank price delivery algorithm, or IPTA, that delivers price to the world, okay, to the world financial institutions and banks, defines the daily range between 12 a.m. New York time and 3 p.m. New York time. Okay, so now the period outside this specific range is often referred to as dead time or less predictable. Okay, so now this is actually a 24-hour time window. Okay, so in other words, what this means, applying this to the concept of price and time. Okay, remember, smart money concept is built around time and price, right? So now we have the 12 a.m. midnight, which is what we can see here. Okay, so now the interbank price delivery, the algorithm is telling us that the that deliver price to the world financial institutions defines the daily range between 12 a.m., which is actually this right here, to 3 p.m. New York time, which is actually this. Okay, so now it refers that the period outside this specific range is often referred to as a dead time. Okay, or less predictable. Okay, in other words, the expected time as an intraday trader to be in and out of the market is between to uh 12 to 3 p.m. Okay, so now incorporating this with the new with the of course excluding the lunch hour, right? Excluding the lunch hour, will not trade in this time of day. Okay, so now looking at this, the 2022 model actually talks about reaching between 12 a.m. 12 a.m. That's for the London key zone, between 2 to 5 a.m. Then for the New York key zone in money section is between 7 to 11. Okay, at most 12. Okay, then the period between 12 to 1 is our lunch hour. Then from 1 to, let's say, probably 4:30 is when we start trading our New York uh, afternoon session. Okay, so now you can see the advancement of how smart of how ICT probably add some adjustments to to its concept. Okay, if you have been following for some time, you will notice that its method of teaching back in those days and now is probably a bit different. Okay, and on a day to day, year to year, is trying actually to make the concept a lot easier to understand. Okay, and which is what actually try to do as well. Okay, I'm trying to make this concept easy for us to understand. Okay, there are probably maybe some of us that have come across this and not likely understand it, but I'm just going to try and make the thing easier for all of us to understand. Okay, so now does that mean with the 2022, does that mean that this concept is already outdated because smart money uh, uh, for the mentorship for the 2022 is actually extended to 4:30 p.m. So that this does not change the algorithm. Okay, this does not change this algorithm. Okay, the 2022 mentorship does not change this algorithm. Okay, you will notice that this was not talked about in the 2022 mentorship. Okay, because this is actually the advanced smart money concept. Okay, this is a course from this more like an advanced model. Okay, so this is not shared on the 2022 mentorship. Okay, so and okay, so that is just that with that. Okay, now the daily structure. Okay, so the daily structure is built around price equilibrium, manipulation, expansion, reversal, retracement, and consolidation. Okay, so now I want to break this down and look at each definition. Okay, so I don't want this video to be probably too long. Each episode should not be more than 30 minutes. Okay, so I'm going to be breaking down each episode to be 30 minutes or less. Okay, so stick around to the end of the video. Okay, so now what is expansion? and I've actually covered this in one of our previous videos, okay, but I'm just going to talk about it in depth, okay, in depthly right here. Okay, so now expansion is when price moves quickly from a level of equilibrium. Okay, so now what we didn't talk about in the previous videos are the importance and what we look for in price, okay, which is what we are actually going to cover in this series. Okay, now when we say expansion is when price moves quickly from a level of equilibrium. Okay, we already know a level of equilibrium, and if we are not familiar with it, we are still going to cover it up in this series. Okay, so now what is the importance? The importance is that when price leaves a level quickly, this indicates a willingness on the part of the market makers to review their intended repricing model. Okay, so now when we have an expansion, what do we look for in price? We look for the other blocks the market makers leave at or near the equilibrium. Okay, so there are going to be, once we have an expansion, there are always going to be other blocks. There are always going to be other blocks in the market, in price, that price is going to leave behind. So that's the footprint we make reference to once we have an expansion. Okay, so now let's go down and see how that looks like in price action. Okay, so now we have the expansion. This is the Aussie dollar 5 minute time frame. Okay, so now we have the consolidation right here. Okay, so we have the consolidation. Now the daily structure actually refers the daily range structure actually refers to uh between 12 to 12 midnight. Okay, so this is actually a daily uh price action data, right? So the structure now is referring to how price is being delivered on a day-to-day basis, which is what we talked about right here. Okay, price delivery, consolidation, next phase expansion, next phase retracement or reversal, and back to consolidation. Okay, so now if you take a look, we're actually going to talk about that deeply. Okay, not in this, I'm just going to, more or less like uh explain the concept that we are going to talk about in depth. We're going to talk about it deeply. Okay, so now what do we look for in price? We look for the other blocks the market makers leave at or near the price. Okay, so now what I want you to imagine right now is this is actually the 12 a.m. midnight, right? Then we have this minor consolidation, we have the expansion to the downside leading into another block right here, but that is not what I'm actually going to try to picture right now. Okay, so I'm actually going to what I want you to do right now is I want you to picture this as, like, prior to this consolidation, I want you to picture this uh as the 12 a.m. midnight. Okay, so this is price opening up on this candle right here. This is price opening up on the 12 a.m. midnight. Okay, so now once, what do we say we look for, or what should we expect on prior to or after the midnight open? What is the first state the market should be in? Okay, it's consolidation. Okay, so now if this is the candles, if this is our 12 a.m. midnight New York candle opening price, okay, so we should see some level of consolidation, right? So now this is which is what we have here. Okay, so this will be our consolidation and this will be our expansion. Okay, so this is our expansion right here. Okay, so an expansion is simply when price moves quickly from a level of equilibrium. Now a level of equilibrium is actually making reference to a consolidating market. Okay, so once we have a consolidating market profile in as like we can see in this example. Okay, so now this is our consolidating market. Now the equilibrium refers to, as we know, the midpoint of the fib. Okay, so now taking this range from this low, because this is the, although we had a short fake breakout. Okay, we had a short fake breakout and we're going to talk about that in a short time. Okay, so now measuring the whole range from this low to this high, the equilibrium refers to the midpoint of the Fibonacci retracement to, right? So now what do we, now we had this expansion, right? We had this move away from the equilibrium. So this is the movement that moved away from the equilibrium, because right before now price was just hovering around the equilibrium, as you can see. Okay, so there was no much movement from the equilibrium. There was this move back in, upwards, back in, upwards. So price was just hovering around the equilibrium, just moving sideways until we got here. Okay, so this is the movement away from the equilibrium. So this is our expansion move, the movement away from this consolidation from where price is resting. Okay, so now this is market maker repricing model. Okay, this is market maker repricing price, or repricing the market, rather repricing the market. Okay, so now we had this own range, right? We have this range, and measuring this range from the low to the high, we have our equilibrium right here. So now what do we make? Now we have our expansion. So what is the reference point? What's the institutional reference point that we make reference to when we have an expansion phase? Okay, what do we look for in price? We look for the other block the market makers leave at or near the equilibrium. Okay, so now what is the equilibrium? The equilibrium of this range is the 50% midpoint, right? So measuring this consolidation right here from the low to the high, where is the what where are the down close candles before the whole move? Okay, which is this? Okay, so these are the sets of down close candle before the expansion. So this is our order block right here. Okay, so as you can see, when price came back, so we mark this out in time as a reference point that smart money are going to come back to in the near future. Okay, so when, and this is going to be our buy entry, right? Because this is the reference point we are making reference to in this repricing model, right? Because we have an expansion, and whenever we have an expansion, what is the reference point we make? Once the institutional reference point, we make reference to other blocks. Okay, so if we have expansion, we make reference to other blocks. Okay, that is just one concept in this. Okay, that is just one of the concept, right? We make reference to other blocks. So in this case, we have this other block near the equilibrium, right? So as you can see, price returned back to it and moved up swiftly. Okay, moved away swiftly. Right now, the next thing, the next stage we are going to be looking at is in deeply is the retracement phase. Okay, so now retracement is when price moves back inside a recently created price range. Okay, a recently created price range. So now what is the importance? When price returns inside the recent price range, this indicates a willingness on the part of the market makers to reprice to levels not efficiently traded for fair value. Okay, so now when we have a retracement, what do we look for in price? We look for fair value gaps and liquidity voids. Okay, so this was actually what this is the only concept that smart money taught, or that ICT talked about in the 2022 mentorship. Okay, so the concept of retracement. Okay, the concept of retracement and fair value gaps and liquidity voids. Though liquidity voids was left out. Okay, we are only looking at fair value gaps. Okay, so now the concept of retracement, we all know what the retracement looked like. Okay, so we had some kind of, probably a move, then a break in structure, right, or shift in structure. This was probably trending upwards, then we had this shift in structure. This So now liquidity voids, which is what we are going to talk about next, we're going to talk about this. So this is actually a liquidity void. Okay, so when we have series of swift movement, huge candle formed like this, so this is a liquidity void. Okay, so this is a liquidity void, this is a liquidity void, this is a liquidity void. Okay, so now, but we are talking about retracement right now. Okay, so we have this old high to this old low. Okay, so now price is going to come back, trading is going to trade back inside this trading range. So what is our trading range? We have this old high to this old low. Okay, so price is going to trade back inside this trading range to reprice to levels not efficiently traded for fair value. Okay, in other words, where are the levels where are the voids that was created by price, where are the gaps, the imbalances that were created by price. Okay, as you can see, we have this, and we have this. Okay, so now as you can see, price traded up into this and traded off. Okay, so now we know what we look for when we have a retracement. The reference point we make, the institutional reference point, we look for the fair value gaps and liquidity voids. Okay, so we are going to cover that in the next series. Now we talked about reversal. Okay, so now reversal is when price moves in the opposite direction that current in the opposite direction that current direction has taken it. Okay, now what is the importance? When price reverse directions, it indicates the market makers have run a level of stops and a significant move should unfold in the new direction. Okay, so now what do we look for in price? The liquidity pool just above an old high or just below an old low. Okay, so now we know the two concepts that was being talked about that was being taught to us in the ICT 2022 model. Okay, it's actually a reversal concept and uh, a bit of retracement, but just the fair value gaps. Okay, I think that's all. Okay, I think that's all. So we talked is actually talking about teaching about the retracement. Okay, which is just one concept of it, the fair value gap and the reversal. So the reversal is more like the old low getting take out prior to each session opening or the old line, because if you look at what we look for in price, what we look for in price when anticipating reversal is the liquidity push just above an old price high or just below an old price low. Okay, so it makes sense right now, guys. It makes sense now. So we have this. So a reversal will look something like this. So we had an old low traded through. So notice that each turning point of this market of price right here, there was always a run on liquidity. Okay, now take a look at here. We had this old low, right? Price traded to taking out liquidity. Then we have a huge move unfold in the other direction. Then we have this old high. Price trades through. Then we have this huge move in this other direction. Then we have this old low being taken out. Just take a look at each time the market turned around, creating a significant move. There was always some level of liquidity being taken out. Okay, so that is just the importance of reversal. So that's the importance of reversal. Now when we are anticipating reversal, what we look for in price is liquidity pools. We look for old lows to be taken out or old highs to be taken out. Okay, so now I'm going to talk about consolidation as the last aspect on this particular episode. Okay, so in the next episode we're going to continue from where we stop. Okay, we're going to continue from here. So now consolidation is when price moves inside a clear trading range and shows no willingness to move significantly higher or lower. Okay, so when price consolidates, it indicates the market makers are allowing orders to build on both sides of the market. Expect a new expansion near term. Okay, so now what do we look for in price? The impulse swing in price away from the equilibrium price that is found exactly in the halfway point of the consolidation range. Okay, this is what I talked about earlier on. This is what I told us about earlier on. Okay, so now the what is in consolidation, and remember, for us to understand, let's go back up for us to understand the algorithmic delivery of price on a day-to-day basis. We have to understand how price is being delivered in the marketplace, and we all know this all this revolves around consolidation. Okay, so in other words, without consolidation, for us as smart money, there is no as smart money traders, there is no trade for us that on that very day. Okay, there is no trade for us on that very day. So we have to have some level of consolidations. Okay, now we are about to learn why consolidations are very important. Okay, now we are about to learn why consolidations are very important. Price consolidates. When price consolidates, take a look at this. When price consolidates, it indicates the market makers are allowing orders to build on both sides of the market. So what we should expect is expansion near term. Okay, so what do we say happens we should expect after a consolidation, right? Expansion. Okay, so you see how these four stages are coming together in play. Okay, so the first thing we talked about here was expansion, right? We talked about expansion and what to look for after we have seen an expansion, which are the other blocks that are left at or near the equilibrium, right? Then we talked about how to determine the equilibrium of a consolidating market. Okay, because every market has to start from some level of consolidation. Okay, so we have this consolidation, right? Then we measure this trading the range of the consolidations from this low to this high. Then the equilibrium is probably here. So the other block found at the equilibrium, right? So which is what price traded back into right here. You can see price used this other block twice. Okay, we hit it here, took off, came back again and hit it once more and took off again. Okay, so now you can see the importance of the other blocks. You can see how they are being filtered out. Okay, so this is just a single concept, right? We have to blend this into with other concepts as well. Okay, as we go further deeply in the smart money trading model concept, we simply look at the highest wick or body of on the consolidation, okay, range to the low, okay, they will measure it like this, okay, and this is only going to be after we have seen an expansion, okay. We only take measurement because if you are taking this measurement right here when there was no expansion, you will have simply missed the other block, right? So we only take this measured move right here when we have seen an expansion in this case, okay, like we can see here, okay. So what we make reference to when price starts retracing, okay. So now I want you to picture this diagram right here, okay, sorry, picture this diagram right here in this simple price action data, okay. Now what do we say is the first stage of every of the price delivering algorithm? What do we say always starts the days up, the day up, okay, every trading day up? Consolidation, okay. So now we have our consolidation, right? Now what is the next phase for us to anticipate? uh Expansion, right? So now this is our expansion, right? So now what is the next stage we said we should anticipate if we have already seen some expansion, okay? We said price will either move to the retracement phase, the retracement phase or the reversal phase, okay. In this case we are seeing the retracement, okay. So price is currently trading back into this trading range, right? So what are smart money actually doing right now? They are trying to show us their repricing model, because that is what we have learned, what a retracement is, okay. So now what is the reference point we make? What's the institutional reference point we make reference to once we have some level of expansion? Okay, we make reference to the uh to the other blocks, okay, to the other block, okay. So in this scenario now, in this case now, what I want you to picture right now is that forget the fact that you have learned about fair value gap, forget breaker blocks, forget you have learned about mitigation blocks, forget you have learned about liquidity voids. The only reference points, the only let's say we are assuming that the only smart money tool you have right now in your arsenal is the order block, okay. So now we have this scenario, okay, we have this expansion, okay. So what are you making reference to? The bullish order block, right? So which are the last consecutive candle before the up move, okay. So that will be this, right? Because measuring this, we are actually making reference to the order block left at equilibrium of the whole range, right? So we have this. So what is the range of this consolidation? That would be this low to this high, okay. So taking out our flip, so what is the other block we are looking for? So we are making reference to these two down close candle, okay. So now as you can see, price trade down and burst off it efficiently, okay. So now you can begin to see how price is being delivered. Price is being delivered efficiently. So we have this and we have this expansion phase again, okay. So now that is the whole picture of what I'm trying to explain right here. Now we are going to look at why consolidations are very important, which is actually what we have here, okay. When the market makers, when price consolidates, it indicates the market makers are allowing others to build on both sides of the market, okay. So we should expect a new expansion near term, right? So now when we have, in this case we have this minor consolidation, right? Now we have the expansion phase, okay. We have the expansion phase. Now what do we make reference to when we have an expansion phase? We make reference to the the other block at the equilibrium, right? So measuring this range from this, because we have this long week. When what do we say about long week? When we have long weeks in any given example, we make reference to the bodies of the candle, okay. So making reference to this, I should have used these bodies right here, okay, or this. So that would actually be at our close to this other block. So this is actually where we bounced off, right? We bounced off this other block. So this is actually a breaker block. It is actually a breaker block, sorry. It didn't reach for the other block, but it reached for this breaker block, okay. But let's say you understood only other blocks in under let's say we're only assuming that other blocks is the only smart money tool you understand, okay. So now picturing this further, at the time we had liquidity being taken out right here, then we have this expansion away from some level of consolidation, right? So now what do we look for? The impulse swing price away from the equilibrium price, okay. We look for the equilibrium price level that is found exactly in the halfway point of the consolidation race, okay. So this will be our consolidation race. So what's the impulse price swing in price away from the equilibrium price, that this will be our impulsive swing away from the equilibrium, because prior to this move, this price was just hovering around this equilibrium, right? It was just hovering around the midpoint. So remember, we only measure the range of the consolidation if we had seen some level of, some level of expansion away from it. Okay, so now probably this video is more than 30 minutes now. Okay, this video is more than 30 minutes, and we are going to, from the next video, I'm going to focus on, we're going to look at what to focus on. Okay, what to focus on in price action, what to focus on in price action. Okay, so now I hope you have found this video insightful. Please do well to leave a comment behind. I really appreciate. It does help me a long way to know that I'm appreciated for this. And if you want us to continue more on this smart money series, please leave a comment, give these videos a thumb up, share it with friends, and if you have not subscribed to this channel, please do well to support us and subscribe to this channel. I'm putting out time, putting out energy, even when I'm not feeling too strong to sit in the front of a computer. I'm trying my best to deliver my promise, and just like I gave my word, and that is what I'm trying to actually achieve right now. Okay, so looking putting my effort in to make this content. So the best thing and the only thing I'm asking for is for you to support this page. Okay, support this community, let us grow together. Subscribe to this channel. It don't take more than 5 seconds of your time, and it's free. Okay, it's not going to cost you anything. Okay, so please, if you have not subscribed to this channel, please do well to subscribe to this channel, turn on the notification bell, and expect more of the smart money advanced trading model. Okay, so see you guys in the second episode. Have a great weekend and a great a new trading week ahead. Okay, see you guys in the next video.